morning, Professor and friends. Welcome to DuPont Corporation case, which is about sale of performance coatings. The overview of this case, the DuPont Corporation is considering an internal review of the value of DuPont performance coatings of DPC fell to DuPont, compared to what other parties might pay for to decide whether to demand this business unit or sell it. There are five agendas we will cover, which are business description, DPC analysis, attractiveness and risk to buyers, APV method, and DPC valuation. Let's begin with the business description of DuPont Corporation. DuPont is an American company. It's one of the world's largest companies in chemical industry. It contains 8 business units, and agriculture is the largest business. Also, the company has set long-term performance goals at 7% sales growth and 12% earning margin. The next slide, it is the business description of DuPont Performance Coating or DPC. The DPC was founded in March 1999. It is an fourth position in the global industrial coating market. It performs in 3 main industries, including motor vehicle original equipment manufacturers or OEM, the motor vehicle aftermarket or refinishing, and general industrial applications. The products make cars look good and move faster. The key of driver of its revenue is mile driven and vehicle sales. From DuPont's internal review, annual revenue growth of DPC was expected to be 3% to 5% in next 2 years. Now, let's take a look on the DPC prospects with DuPont. Do you think that DPC fits with DuPont? We think no. From the case, the CEO has attempted to change the company's strategy for it to move the focus from commodity chemicals to a specialty chemical and science-focused products business that give higher growth and margin. Now, the outlook of business is at core of industrial biotechnology. The company was positioned to compete in architecture, nutrition, and advanced materials, which will be the driver of growth over the next few years. Moreover, DuPont had its fast pace on this focus for many years. All factors said and its characteristics, DPC clearly does not fit with this new strategy. From DPC's financial performance, the sales declined to -3% and profit declined to -6% between 2007 and 2011. According to our analysis, we think that it is difficult for DPC to make the target growth and margin because of the strategic mile driven, less number of accidents, more return of cars, and advanced coating in OEM for new vehicles, which make it more durable and negatively affect the refinishing business. DPC expected growth is flat and its margin is the lowest among all business units. From the case, growth of 12.5% in 2011 was caused by only price increase. This improvement did not last long. So, we think that in the future, if the DPC had to decrease its price, it will feel low due to increase in costs such as crude oil price and environmental compliance costs, right in competition, and not be able to reach that target margin. If the company does not increase the market share in other areas, DPC potential value will not be much higher than the current state. So, DPC needs to focus on its own and increase sales to new markets, like emerging markets. Move on quickly to the DPC prospects with outside parties. Compared to DPC being with outside parties, it would be attractive because it has a strong market position, reliable brand and global footprint. Besides, due to the US market starting saturate, emerging markets such as Asia show big opportunities to expand this coating market, which affect its potential growth. But DuPont had a competitive advantage in advanced technology and R&D. Therefore, DPC being with outside parties had to worry about the high cost of capital expenditures and R&D. Although the outside parties had increased their sales, they have to carry these costs. So, the potential value of the DPC may not be higher if outside parties cannot reach higher sales.
Next, let me talk about the attractiveness of DPC as an acquisition target. From a strategic buyer viewpoint, the attractiveness of DPC are the opportunity for operating synergy and financial synergy. Operating synergy is when the value and performance of two firms combined is greater than sum of separate firms apart and allow for the firm to increase their operating income and achieve higher growth. Operating synergy can arise from economy of scale, greater pricing power, and higher margin resulting from greater market share and lower competition. Combination of different functional strengths such as marketing skill and good product line, and higher level of growth from a target customer base. Operating synergy is an important reason why significant premiums are sometimes paid by strategic buyers. Also, financial synergy can arise from the lower cost of borrowing that is the benefit from large size of companies. The potential is mainly relevant to different cultures that can be the barrier to achieve the operating synergy that the strategic buyer had expected. Another risk is the buyer might overestimate for a deal due to an inadequate evaluation of a target and might face a financial risk if it used debt financing to pay for a deal. From a private equity firm viewpoint, the attractiveness of DPC is the benefit of high leverage that will increase its return. Since DPC as a standalone company is all equity finance, it allows PE to let debt financing. As a result, the smaller the equity base, the higher the return PE will receive at exit. Also, when comparing DPC with its closest peer, DPC can increase sales growth and improve its operating margin, resulting in an increase in enterprise value. PE will benefit from it, as gain from exit opportunity when PE sell DPC to a strategic buyer, another PE, or issue an IPO. The risk in this type of deal is relevant to financing decisions that PE use to pay for a deal. Since PE use high leverage to purchase DPC, the relatively small decline in enterprise value could substantially reduce the value of its equity. The other risk that might arise is probability of loss due to the selling price at exit. If DPC fail to increase sales growth and operating margin after PE bought it, the selling price will be lower than the price PE firm had bought. The last thing that the buyer might face is a financial risk due to the inability to pay back the creditor.
First of all, we would say that based on this case study, we used adjusted present value to do a valuation. And you will wonder what and why we use APV approach. Let's take a look at this approach together. To begin with, what is APV? APV or adjusted present value is a valuation method introduced in 1974 by Stuart C. Myers. The idea is to value the company or project which are highly financed by leverage and then using the unlevered cost of capital to discount free cash flows. The value of the firm calculated by takes the value of the firm without debt or the unlevered firm plus the present value of debt financing costs, which include interest tax shields, cost of debt issuance, cost of financial distress, financial subsidies, etc. And you can see the formula of APV as follows. Next, we would talk about the features of adjusted present value. There are some features of APV. First, the APV method is most useful when evaluating company or project which a fixed debt schedule, as it can easily accommodate the side effect of financing. Secondly, APV shows an investor the benefit of tax shields from tax-deductible interest payments. And lastly, unlike the WACC approach, that it used the debt tax shield as part of the discount rate. But as you can see from the formula, the APV method separates project value into one component associated with the unlevered project and another associated with its financing program. Each component is evaluated separately. The APV is simply the sum of the two components, which are NPV of all equity finance and NPV of financing effects, which is the sum of various effects. So it can be used to account for each financing side effect.
To be more rational, there are some reasons why APV is a better approach comparing with NPV in the case of LBO. Because of the high portions of debt financing, APV will clearly show the benefits of tax shield in dollar value, whereas NPV method does not. This separation will let the investor or third party to analyze in an easier and appropriate way when the deal is using high leverage. Second, the general and essential assumptions of using WACC in NPV is a constant capital structure over the time, but in LBO it is not. Large amount of debt it is used, and a certain level of debt over the time is known. So, if we assume that the capital structure is constant, it will not give us the accurate EV. In the first part of APV valuation, present value of unlevered cash flow assume that the firm is all equity financed, so we can use the unlevered cost of equity instead of WACC. So we will show you the estimation of DPC enterprise value. As you can see in the table, in part A, the higher revenue growth from the base case, 4% to 5%, operating margin growth, 10% to 12%, contribute a higher enterprise value of DPC in the amount of $4,859 million, which refers to the estimated firm value that private equity will have to pay if it's acquired DPC with all equity financing. In part B, when adding a higher sales price EBITDA multiple from 7 to 7.5, it means that the selling price in the next 5 years will be higher, which will also result in the higher EV of $5,102 million. Moreover, using our equity funding to acquire the business is not only one approach. From the part C, PE will use the leverage to acquire DPC with a multiple of 6 forward EBITDA. This results in the increase of EV to $5,350 million. To conclude, there are three key factors that affect to EV. The first one is operational performance. The second one is terminal value or selling price. And the last one is debt financing.
Now, we will talk about additional assumption in 4C and how it come up with that enterprise value. The debt multiple is 6 times forward EBITDA, result in debt amount of $3,900 million. Our residual cash flow will be used to repay the debt each year, and after 2016, the firm will revert to all equity finance. Lastly, we know that in the real world, it takes time to arrange the deal, maybe a quarter before the investment starts. However, according to the case that use a full year analysis, and for a fair comparison, we assume that the investment period starts on the 1st January of 2012. For debt schedule, our project residual cash flow is as follows, and all of them will be used for debt repayment. However, in the end of year 5, there is still $2,800 million of outstanding debt. This amount will be paid by the money generated from exit sales of private equity fund. The interest payment is calculated at 6.75% annually, and the tax shield is calculated at 25% tax rate. Since the firm will revert to all equity firm after year 5, the terminal value of tax shield is 0. In our APV calculation, the free cash flow and terminal value will be discounted with unlevered cost of equity at 11.2%, and the interest tax shield is discounted at pre-tax cost of debt at 6.75%. Combining the PV of cash flows and terminal value, we get an enterprise value without tax yield of $5,100 million, which is exactly equal with 4B since the first part of APV method assumes that the company is all equity financed. Now, because the firm is not using leverage, we add the net effect of debt of $248 million to the enterprise value. Finally, we get an enterprise value with tax yield of $5,350 million that give a dollar increase of 1,380. If we assume that the enterprise value is the purchase price for private equity, they are acquiring the firm with the purchase price multiple of 8.18 times forward EBITDA. The purchase price multiple is quite high, but still lower than average in 2011, which is 9. This suggests a high chance that the PE will accept this rate. However, since they use debt as part of funds, the initial investment that they must put in is only $1,400 million. This will allow the PE to get higher return later. In exit sales, the PE will get around $3,300 million since they must use the cash generated from sales to pay all the outstanding debt in 2016 in order to allow the firm to revert to all equity firm again. With the use of leverage, the PE will get an IRR of 18.81%, higher than prior case. Nevertheless, this amount of IRR is still lower than the rate that the financial brand trying to settle. That is 20%, as mentioned in the case. In order to get more IRR, we suggest that the PE must try to lower the purchase price, boost more sales, or use more leverage. In our analysis, they must use the debt multiple of 6.26 times forward EBITDA in order to get an IRR of 20%.
Theoretically, financial leverage will be generally increased when the firm has the additional debt. Before and after using debt, the firm needs to understand what are the sequences for this action. There are advantages. Obviously, it's called tax benefit or tax shield. When an interest expense is tax deductible, the cost of raising additional fund will be lower than using equity. Then, using leverage can enhance earning if the firm is profitable. Proportioning to the equity invest or asset existed with the leverage, the investor will receive unproportionate greater return. As we have known, mostly firm has agency conflict. If the firm has a high level of debt, it indirectly leads to the agency conflict decrease. The reason is that shareholder will try to generate profit expecting the residual income after tax and no bankruptcy happen. And also debt holder, because of the shareholder intention, the interest and repayment can be more assured at the first place. On the other hand, as mentioned, there is an opportunity for investors to gain an extra return, but in a downturn period, there are some financial risks which the investor also have to bear unproportionate losses, such as financial distress and bankruptcy. Moreover, with a high existing level of debt, if the firm has a plan to invest more, the possibility might be lower than the first-time borrowing, or the cost of fund will be higher because of the firm riskiness that reduce its credit and outweigh the benefits of WACC. Lastly, in the burden of bearing much debt, the firm will have a lower flexibility to make decisions for new investment and following with an underinvestment issue that affect the firm growth. Last but not least, DuPont can apply this analysis into discussion, and please keep in mind that the deal structure highly depends on the negotiation between DuPont and the buyers. Thank you for your attention.